Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, May 27th, just after the close. Well, the 8th week was the trick for the equity markets. After 7 consecutive down weeks, highly unusual, got a little bit of a rally this week, got some air back in the balloon this week. A couple of things happened to allow that. Over the last 2 or 3 weeks, we've been talking about what we'd like to see to take some pressure off the equity market. The first was for rates to level out. Interest rates leveled out nicely. As a matter of fact, interest rates, bonds rallied with rates falling, specifically in Muni bonds. John will comment on that shortly. Muni bonds ripped midweek through the end of the week. We've seen bonds in portfolios marking up 3, 4, 5%. So that was a nice move. Rates leveled off. The dollar came down a little bit. It at least stopped going up. U.S. profits can get a little leverage added to them with a little bit of a weaker dollar. The one thing that hasn't come in line is oil. West Texas went out at about 114 a barrel. This is a big problem and can continue to be a problem in terms of wallet share for clients, wallet share for citizens, pumps getting expensive, summer coming up, driving season. We'll keep an eye on that. There's a real refining problem in the country. We're operating at about 70% less refining capacity as we were 20 years ago. So we're all in agreement over what has to happen for the environment, but there are certain scenarios that can really cause a pinch in this energy market, and we're seeing it right now. In terms of equities and what tipped us off or what could have tipped us off, because it's always important to look at how you're positioned, look at where we are in the market, what you could do right, what you've done wrong. So in terms of what we saw last week, and if you go back to last Friday's video, there were some real positives. If you remember, last Wednesday, big down day, 4% plus in the NASDAQ. I think the S&P was off, let's call it 3.5%. Thursday, down open with a little bit of a rally. Friday, hard down open. Hard down morning with a lot of demand that came in mid-afternoon. If you recall back to last Friday, that was the market, it appeared, starting to repair itself. Monday, solid day this week. Tuesday, down open. Now, for the last month, for the last 6 weeks, when you had those down opens, the market had a real difficult time creating demand, healing itself. Real demand came in Tuesday afternoon. So that was another turning point. Now, one of the things we're fond of saying is, to be a successful investor, to be a successful trader, you can't get too high, you can't get too low. And we're at one of those scenarios now where you almost run the risk of thinking the worst is behind us. Probably not. We're probably going to see a ton of volatility over the next 30, 60 days. Volatility doesn't just disappear in the equity markets when it's facing a Fed that, for all intents and purposes, is a headwind, and that continue war in Ukraine. So in terms of how we're positioned, we put, as we mentioned last Friday, put a little money to work in pharmaceuticals, in tactical. Still have a nice slug of cash. We're in the 25% range in tactical. In U.S. core, we're sitting with about 20% cash. In U.S. equity, which the difference between core and equity is core focuses on primarily indices. U.S. equity gets down into industries and sectors, sitting 13, 14% cash. So we have cash. As the market comes in and presents reasonable opportunities, we now have some levels to trade against. Very important. It's awfully tough to buy a market that keeps making lows. When a market moves higher, now you have some lows to trade against. So we'll see what next week brings. The last hour today with a very thin market and the bond market closed, prices really gapped up probably got ahead of themselves in an awful lot of situations. May see a little bit of pullback next week, but now we have, again, some areas where we've seen demand in individual names, in sectors, and in indices. We have something to trade against and can get some of that cash to work. Have a nice Memorial Day weekend. We're going to shoot it over to the Moose for some more commentary on bonds.
Hi, it's John Mousseau. I'm the CEO and Director of Fixed Income at Cumberland Advisors. When you start to look at bonds this week, what did we see in Treasuries? We saw pretty decent movement, but really staying around the same levels that we were, down a little bit. 10-year bond, 273, 30-year bond, 296, down 3 or 4 ticks. Most important is that we've continued to see stabilization in the Treasury market. And I think it's important to remember that those numbers back just around the first week of May were at a 3 and a 322 respectively, the 10 and the 30 year. So that's a fairly decent change. What this stabilization has allowed to do is something we've talked about. It's other markets being able to now stabilize. It means some taxable bonds like taxable munis and corporate spreads starting to come in. And in Munis, just an unbelievable rally in the last week. Really 50 basis points down in the 10-year and the 30-year AAA scale, which means that other paper, lower rated paper, probably did even better. Really a gap up performance, and certainly long overdue because Munis were very oversold. We've talked about bond fund flows, still negative, but less negative than they were. We're down to about $1.5 billion. They're moving in the right direction. We wouldn't be surprised to see fund inflows fairly soon because now there'll be some hot money chasing the market, which is moving in another direction. We still think munis are very attractive. It's just a lot different when you were buying bonds at 140% yields and to treasuries, and now they're down a lot closer to 100. And in some cases, for us, it validates some of the work that we've been doing in extending portfolios and maturities. We're going to continue to do that because we still think munis are incredibly attractive. We're still able to buy 4%. You just can't buy 4.5%. But the long treasury bond, instead of being at 310, is also down in the mid 290s. So munis have maintained still relative attractiveness. Supply is going to be a little muted coming into a holiday week. That probably works in the favor of munis. Bond fund flows becoming less negative, probably positive. That works well. Next week, not too much in terms of statistics, except for we will see unemployment at the end of the week, the employment report. That will be important as always. One thing this week, PCE, the Fed's favorite measure of inflation, was relatively behaved at 0.2. It was right on expectations. But the idea is, again, the month-over-month numbers are lower. And we'll continue to look at that. And when we get into next month, we'll look at the same thing in CPI and PPI. We hope everyone has a great weekend.
Thanks so much, Moose. Great color on the bond market. Don't forget to like, comment, and subscribe. We'll see you next Friday.